All right, let's talk about this little sell-off we got here. Fresh off of all-time highs, how big of a deal should we make of it? Joining me, Kevin Gordon, Senior Investment Strategist at Charles Schwab, and Cooper Howard, Director and Fixed Income Strategist at Schwab Center for Financial Research. Good afternoon, team. Kevin, at what point in the midst of a massive rally should we take second note of any downside?
Well, I think key to keep in mind is that, consolidations in an ongoing uptrend, especially when you have relatively frothy sentiment, which is basically the environment that we have right now, those are normal. And that's actually a feature of bull markets over time. So if this turns into more of a corrective phase, down 5, down 10%, I actually don't think that's a terrible thing. And, something to wring out a lot of the froth, I think would be welcome. So, a day like today, is pretty emblematic of that, especially because it's not clear that there's one particular economic driver that's driving this move. You had relative resilience on the services, PMI this morning. You had relative weakness in some of the manufacturing data this morning. And when you look at the sector composition and what's leading to the downside today, specifically at the member level, with a lot of the mega caps down the most, it's pretty clear that year-to-date leaders are leading to the downside today.
All right. That data this morning, Cooper, take us through it. What stood out to you? Because it did add some wrinkles into the market, which was already under some pressure, but big rally in bonds, big drop in the dollar, at least in that instant.
Yeah, I think it added a little bit of a wrinkle. I wouldn't say too much of a wrinkle in terms of the overall narrative of kind of where the market's headed right now. Like Kevin mentioned, we did see some weakness on the services side. You saw yields drop a little bit quite right after that. But overall, I think that if you look at the longer term view of where yields are headed and where they have been, it's been quite the run up since the beginning of the year. So to see somewhat of a decline just recently, that's not too big of a surprise. We've always been looking at fair value for the 10-year to be about under 4%. Granted, it's going to be choppy and it's going to be day-to-day moves in terms of volatility to get there, but it's not too big of a surprise to see a little bit of a downside in yields today at Oliver.
What about the downside in the yield curve? If we go to 10s to 2s, Cooper, we had this kind of miraculous steepening without any cuts the second half of last year coming into this year. It's not deeply inverting again, but we are kind of near those lows of the range from the last 4 or 5 months for the spread. What do you make of that?
Yeah, I think that the market's trying to kind of navigate what the Fed is going to do. And I think that a lot of the move, if you look at the 2-year, that's trying to anticipate where the Fed is going to go. If you look at the 10-year, that's more trading off of the outlook for growth. And it seems that the picture for global growth seems to be picking up, although we do expect it to slow over time. But there can be a narrative to be made that potentially we are seeing stronger than expected growth. So I think that's where you're seeing moves on the 10-year. But in terms of our outlook for Fed policy, Oliver, we do expect that the Fed is going to cut between 3 and 4 times. It looks like it's going to probably the first rate cut this summer. I think what's also going to be interesting to watch is what does Chairman Powell say, or what doesn't he say tomorrow during the congressional testimony? Yeah. I would be surprised if he gives any major hints to the market or kind of deviates off of the script that he and a lot of other Fed speakers have been following. So it could be a case of volatility. I would be surprised, though.
It has almost felt a little script reading like, for the most part, with a few exceptions to the rule in terms of the Fed lineup. Kevin, in the next 2 days, as we hear from Jerome Powell, do you think there's a possibility we sway from what has been generally a gravitation towards that June cut? It seems like that's kind of been the fair value the market has agreed on now for some time.
Yeah, I think in general, there's a little bit too much obsession as to when the first cut is going to happen. Really, to me at least, it's really why the cuts happen and then what the actual cycle looks like. So if it's a slow and steady cutting cycle, it starts this summer, if you were just to pick the, let's say it's June. If it's slow and steady, historically that tends to be positive in general for the stock market, but also the broader economy, because it would at least signal in this current cycle that the economy can handle, rates where they're at in a restrictive level. So 3 or 4 cuts from the current level today, current Fed funds rate today, still leaves you at a pretty elevated level. And that's assuming that inflation continues to trend lower. So you would still be at relatively restrictive territory in terms of real rates. If the cuts were, aggressive and were not telegraphed in being aggressive, so you get something to the tune of, a series of 25 basis point cuts or 50 basis point cuts, that would be, I think, a much more dire signal for the market, at least. So, it'd certainly be more consistent with a recession. So I really don't think it's as much of, when do they start? They'll probably signal that to us because they've been doing that this entire cycle. So I don't think that there's going to be sort of any, phantom policy making behind the scenes and then all of a sudden they spring it upon us. I think it's going to be telegraphed. And then, when we get to the point of the first cut, tell me the economic data at that point, and I'll tell you whether it's a good or a bad cut.
Okay, I like that point. At this juncture, does it still look like more a good cut than a bad cut to you, Cooper? Or is it too early to tell?
I think it is early to tell. We have a few CPI, PCA reports, unemployment reports before we actually get to that first cut. Maybe we don't before we get to that first cut, depending on when it is. So I think it is too early to tell, is it going to be a good or a bad cut? Because there is a lot of economic data between now and then.
All right. Yeah, true. We do have a big employment report on Friday. Kevin, give us a last thought. What do you think should generally be in our realm of expectations there?
So I think, headline payrolls always gets the most attention, but particularly for this, because of the dynamics that you saw in January, maybe they were weather related. I think the situation with hours worked, so the work week, the length of the average work week, and then actual average hourly earnings, those two components I think are most important, because if you get a full reversal in both of those, it basically dispels all of the fear that everybody had from an inflationary standpoint in January. But if the work week comes back up and average hourly earnings growth doesn't, and it stays relatively elevated, that I could see, being a little bit more of a concern from an overheating labor market or overheating wage, situation. So I think the dynamic between those two, of course, in addition to everything else we watch in terms of labor force participation and sector payroll growth, but those two I would put probably at the top of the list in terms of what I'm looking at most closely.
All right, great stuff. Excellent work. Nice duo. Kevin Gore and Cooper Howard. Appreciate it very much, guys.